Welcome back to the Financial Autonomy Podcast. My name's Paul Benson, financial planner and practice principal at Guidance Financial Services. Today, we're diving into a deceptively simple but incredibly powerful concept, opportunity cost. Now, that might sound like something out of an economics textbook, but don't tune out just yet, because understanding opportunity cost is one of the most useful tools you can have in making smarter financial decisions. Let's dive in. Okay, so let's start with what is opportunity cost. Opportunity cost is the value that you give up when you choose one thing over another. For every dollar, every hour, every decision, they all have trade-offs. If you buy a new car, the opportunity cost might be the investment returns that money could have earned if you've left it in your investment account or perhaps your super fund if you're retired. If you decide to work 4 days a week instead of 5, the opportunity cost is the income and super contributions you'll forgo. But the benefit might be more time with family or less stress. So opportunity cost isn't about guilt or regret, it's about awareness, recognizing that every yes comes with an implicit no somewhere else. One area where opportunity cost regularly comes up in my conversations with clients is around personal insurance, so life insurance, income protection, trauma cover. Insurance is a really interesting case study because on one hand, it's a vital safety net. If something goes wrong, it can save you and your family from financial disaster. But on the other hand, insurance isn't free, and the cost can be significant, especially as you get older. Let's imagine you're in your 40s, your earnings are good and you've got a young family. You might have $2,000 a year going towards some life insurance, say $1,200 towards some income protection and a bit more for trauma insurance. All up, let's say you're spending $4,000 a year on insurance, some of which is probably coming out of your super and some you're paying directly. Now, if you keep those policies for 20 years, say until your kids are into adulthood, then you'll spend roughly $80,000 in today's dollars. In fact, it'd probably be more than that because the premiums increase with age, but let's go with that. So the opportunity cost of that $80,000, if they had been invested instead, could be $160,000 or more in future value, depending on the returns. So it's quite meaningful. Now, does that mean that you shouldn't have insurance? Look, of course not. For many people, the protection is essential. But the key is calibration. Having too much cover can quietly eat away at your long-term wealth. Having too little, though, can leave you exposed. The best approach then is to be intentional. Understand what you're protecting, for how long, and to recognise that the dollars going to premiums are dollars not compounding elsewhere. Another really common example of opportunity cost arises when parents help their children into the property market. Look, it's a beautiful and a generous thing to do if it's affordable to you. We all want to see our kids get ahead, but it's worth running the mental calculation. What does this mean for me later on? Let's say you gift your child $200,000 as a home deposit. If you're 60 now, that money might otherwise have stayed invested for your retirement. If you assume a 6% return over the next 20 years, that's roughly $640,000 of future value that's no longer there to support you. Now, that doesn't mean you shouldn't help your kids, but it does mean you should go in with your eyes open. Maybe you decide to lend the money instead of gifting it outright. Or maybe you help with a smaller amount that won't compromise your retirement lifestyle. Opportunity cost gives you the language and framework to weigh those decisions up. It stops generosity today from becoming financial stress tomorrow. Opportunity cost doesn't only apply to big, life-changing choices. It's at play in everyday financial behaviour. When you keep $50,000 sitting in a low-interest savings account for safety, the opportunity cost is the higher return that you could have earned elsewhere. When you buy a bigger house than you really need, the opportunity cost is the investment returns and the flexibility that you use by tying up more capital in property. When you decide to delay starting salary sacrificing into super, the opportunity cost is the compounding that you miss in those early years. And that's something you can never get back. We often talk about risk in terms of losing money, but the risk of missed opportunities can be just as damaging over time. So how do you bring this idea into your financial decision making in a practical way? Well, here's 3 suggestions that I've got for you. Firstly, always ask compared to what. So when you're about to spend or commit money, ask, what else could I do with this money? The simple question frames the decision and often reveals the hidden cost. Use goals as your benchmark, and I often talk about goals and objectives, but it's certainly relevant here. Opportunity cost isn't about maximising every dollar, it's about aligning your spending and investing with what truly matters. If helping your kids into a home brings you joy and fits within your retirement goals, that might be a trade-off worth making. Number 3 here, think long term. So humans are wired to value the present more than the future. It's what economists call present bias. Opportunity cost helps counter that. It reminds you that your future self deserves some consideration too. Let's do a quick thought experiment. Imagine 2 versions of you. One chooses to invest an extra $10,000 a year into super. The other decides to use that money for extra holidays and lifestyle spending. After 20 years, the first version might have an additional $400,000 in retirement savings. The second, though, might have amazing memories and experiences. Neither is wrong, but each has an opportunity cost. The question is, which outcome better aligns with your values and priorities? When you see the world through the lens of opportunity cost, there's no such thing as a free decision. Every choice is a trade-off, and being conscious of that is what smart financial planning is all about. Okay, so to wrap up, opportunity cost is the hidden price tag attached to every financial decision. Whether it's insurance premiums, helping your children, upgrading your car, or choosing how much to work, there's always something else those resources could be doing for you. The goal isn't to avoid spending or to feel guilty about your choices, it's simply to be deliberate, to make decisions that support the kind of life you want, both now and in the future. That's what financial autonomy is really all about, understanding your options, weighing the trade-offs, and choosing the path that delivers the most value for you. All right, well, look, I think that'll do it for this week. Thanks for listening to another episode. If you found it helpful, please do share it to friends, family, whoever you think might get some value out of it. Of course, if you're not currently getting the Gaining Choice newsletter, that's a Friday email. Add yourself to the list there. Just go to the guidance website and you'll see there's a box down towards the bottom that you can add yourself to the list there. But otherwise, I'm going to finish up. Nick will be with you next week, of course, with a Wealth Builder episode, and I'll be back in a fortnight's time. Bye for now.